So at this point, whether the Fed hikes or not in June, has the Fed boxed itself in? Peter Schiff is Euro Pacific Capital's president and CEO. You know, Peter, a lot of people would contend that the Fed has painted itself in the corner, implying that it's got to raise in either June or July. Why do you say the Fed might not raise at all?
Well, I still think the odds favor another punt. And, you know, they said they were data dependent. And if you actually look at the data that's come out since the last FOMC meeting, you know, it was those minutes that got everybody thinking rate hike. Most of the data has gotten worse. Certainly the jobs data has been worse, but most of the economic data, including most of the economic data we've got this week, was well below expectations. So I don't see a second quarter rebound, and that was contingent. The Fed said, well, if the economy improves and the job market improves, we might raise rates. Well, neither are improving. In fact, it's more likely they're going in the other direction.
Hey, Peter, it's Brian Kelly. So I'm curious, in terms of the Fed being boxed in, how does the dollar play into this? Because as I see it, if the Fed raises rates, we have a much stronger dollar. If they don't, I'm not sure that I think the rest of the world would start covering shorts. Do you have a view on that?
Well, you know, I don't think so, because the last time the Fed raised rates, everybody thought it would be good for the dollar, and the dollar went down. And, you know, I think this is a repeat of what happened last year. You know, the Fed launches a trial balloon. They raise the possibility of a rate hike, and they wait and see how the markets react. And the markets are basically reacting positively, just like they did in December last year. Everybody was convinced there was a rate hike, but the markets were rising anyway. And I think that it was the increase in the markets that gave the Fed the false confidence to actually raise rates. But as soon as they did, the market sold off. We had the worst start to a year in history. And I think the same thing will happen if they raise rates in June. I think the market's going to sell off. I think gold's going to rally again. And I think the dollar is going to sell off, because these rate hikes are too little too late. Everybody knows that the Fed is ending its tightening cycle. Whether it makes one more quarter-point hike or not is immaterial, because by the end of the year, they're going to have to take all this stuff back. They're going to be cutting rates. They're going to be doing QE4. And I think the only...
But, Peter, you know, ultimately...
I think we're having some technical difficulties with Peter's shot, of course. We'll try and get him back online, because we were just in the middle of a great conversation here. I mean, that saying that there's going to be QE4 by the end of the year, that implies, if we get him back, we'll ask him, a recession at that point.
I think there's a couple problems I have with Peter's analysis. I mean, first of all, no matter what he says, gold is always going higher, and gold has been going higher for 3 years. And the Fed, it's always a phony rally. Now, meanwhile, if you've just invested in gold for the last 3 years and you've thrown treasuries out the window and you said it's a phony rally, you've missed the biggest equity rally we've had, arguably, in the last generation. You've missed a treasury rally that's probably going to continue on, and gold is down $800 an ounce. So, you know, to me, it doesn't matter what the Fed is doing in the textbooks and theoretically what's good for the economy. What's good for the markets is actually that the Fed has been doing what they're doing. And so I'm not someone that believes that things are going to go swimmingly for the Fed at their next move. I think more Fed equals more volatility, and I think they've got a tough place to go, like everybody here on this desk. And I'm thrilled that we continue to rely on monetary policy to get us out of it. But the reality is that those have been bad trades. And we continue to get up here over and over again and talk about them. I wish we could continue to talk about it.
Peter's point about what happened in December when they raised rate, and then, you know, a month later we had the worst start to the year, I think is well taken, in that the markets seemed to not react directly on the day that things happened, even when it came with the Chinese yuan devaluation. It took 3 or 4 days, or even took a week, before the stock market here in the U.S. actually reacted to it. So I think there's something to be said to that. And I would mention, just on the dollar, and you look at what's going on in China, China's going to actually talk to the Fed and say, hey, when are you going to raise rates? They're trying to get a little, you know, an edge here. I think that's a development you got to watch, which would go to exactly what Tim's saying. I think between now and the Fed meeting, you're going to have an awful lot of...
But I think what he's saying, though, is that the Fed has created an asset bubble inside the stock exchange, inside, I should say, the equity markets. So whether that's good or bad, your point is accurate. It's been a great trade. The market has rallied aggressively. But when it ends, you're talking about drastically lower prices in the equity market, probably on valuation. 1,500.
We have Peter Schiff back. Peter, it's good to have you back. I think that's the first time you've ever been at a loss for words. You're in the midst.
I wasn't at a loss.
I guess you kept talking. You probably kept talking, even though the shot went down. You're in the midst, though, of telling us that by the end of the year, you believe that the Fed will rein back in all of the hikes that it had done to that point, and it will have embarked on QE4. What's the backdrop to that?
I don't know that they're going to. I don't know that they're going to get all that done by the end of the year, but they're going to have to reverse course and start backtracking, because I think we already are in a recession. And I think by the time they go back and they revise the numbers that we got for the fourth quarter of last year, early this year, I think the data is going to reflect that we've been in a recession. They never know that you're in a recession until you're almost finished with it, although I think this one is going to than the last one, so they're going to have to rename it. But I heard you guys talk about the stock market, how great it's been. The stock market has gone nowhere for the last year. The average stock is down. Look, this has been the worst year in 18 years for managed money.
I'm not talking about the last year, though, Peter. You've been saying this same story for the last 3 years. You've been telling me that gold's going to the moon. You've been telling me that treasuries, we're going to default. The U.S. government, no one's going to want to invest in U.S. treasuries. And you've been saying, get out of the stock market. What have you been saying? I can go back to 2013 and pull this stuff up. Don't put words in my mouth. And first of all, yes, I was warning about the housing bubble for years before it burst. I was warning about the financial crisis for years before it burst. So plenty of people on CNBC were making fun of me in 2006 and 2007. Peter, you've been coming on for years. Nothing's happening. Nothing wrong. And then everything collapsed. So what have you been saying other than the Fed has got a phony economy here and that gold's going to 5,000 in the next few months? No, what I've been saying is everything the Fed has done since the financial crisis has made the underlying problems that caused that crisis worse. And so because of that, we are on the verge of a much worse economic crisis. We are more addicted to cheap money now than ever before. There have been more mistakes, more malinvestments. This is the biggest bubble the Fed has ever inflated. And the ramifications will be much more enormous when it pops. There won't be any bailouts. There won't be any TARP program. How do you suggest we play that? Because this is a trading show, and you're talking a lot of theory that you've been talking the same thing for the last 3 years. So how would you play this right now? And how long was I telling people to short subprime mortgages before the trade paid off? I wasn't old enough to watch.
Okay, hold on. I'm going to step in here. So are you short the markets? Because that seems like the most direct trade here.
No, I am not short the market, right? Because I do believe that the Fed will put a floor beneath the market by printing money. But the ultimate collapse is in the dollar. It hasn't happened yet, but the Fed is going to sacrifice the dollar. In fact, even when Donald Trump spoke the truth about the fact that we need to renegotiate our Treasury debt, we have to restructure it because we can't possibly pay it back, then he backtracked and said, no, we'll just print money. Well, that's what we do. We print money because we can't repay our debt. It's all about monetary policy. Let me finish. It's all about perception, right? Puerto Rico is broke. We all know that. But it was broke 2 years ago. It was broke 3 years ago. Why didn't anybody care? The creditors kept lending them money even though they were broke. Well, eventually people wake up and they realize that a debtor is broke. America is more bankrupt than Puerto Rico. Our creditors haven't figured it out yet. We might not default, but we will print. So when the Fed has to go back to zero, when they have to relaunch QE, when they maybe have to go negative, and people realize that none of this worked, that Ben Bernanke's book, The Courage to Act, needs to go into the fiction section because none of it is true. Actually, I would argue with so much of that, but we don't have enough time on the show. The bottom line is the Fed is in a position where actually more people want their debt and actually think it's the best credit in the world at a time when it's very difficult to understand who the best creditors are. Yes, so a lot of people want an economy that is doing significantly better, and the Fed is probably able to buy back their debt. It's not doing good. Or issue at much better rates now than they were 4 or 5 years ago. Right now, the Fed is in the catbird seat. No, it's not. They felt they were in the catbird seat right before the financial crisis. You think there was a single person on the Fed that had any concern about the housing market, about the mortgage market? They were as blind as the bat. Janet Yellen was the leader of the deniers. She thought everything was great, there was nothing wrong, and we were around the corner from a complete collapse. They have no track record of predicting anything.
We've got 15 seconds left, Peter. You're long gold. What? You short treasuries, short U.S. dollar?
No, I'm not. I'm not short treasuries, but I am short the dollar in that I am long foreign assets. I'm long foreign stocks. I'm long gold stocks. Look how much gold stocks are up this year. You guys own any of those?
Peter, great to speak with you. Thank you. Peter Schiff, Euro Pacific Capital.